Welcome everyone, and thank you for standing by. At this time, I would like to inform all participants that your lines will be in a listen-only mode until the question and answer session of today's conference call. If you would like to ask questions during public comments, please press star 1 on your phone. Please record your name when prompted so we know who to introduce. I will now turn the meeting over to our first speaker, Ms. Melissa Flores. Thank you. You may begin.
Good morning, everyone. I want to welcome you all to the May 14th meeting of the CalHFA Board of Directors. I hope that's what you're intending to be here. We are holding this meeting by remote access only today. It's in compliance with the Bagway King Act and executive orders in 2920 and in 3320 due to the unprecedented situation with the coronavirus. Today's meeting is being teleconferenced. The board members are in varying locations throughout the state. You can also view the meeting by live stream, and you can find the live stream link and materials for all the items that will be discussed today on the board section of the CalHFA website, and that's calhfa.ca.gov. You may notice if you are listening to the call and watching it via live stream, there may be a slight delay between what you're hearing and what you're seeing. And the live stream does depend on your access, so the delay can vary. And if you're a member of the public, there will be an opportunity for you to address the board later in the meeting. We ask that anybody speaking, please be careful not to talk over others and to also say your name when you start to speak so we can have that as part of the record. And I think that's it. Mr. Gunning, I think I'll turn the meeting over to you.
Well, thank you, Melissa. Can everybody hear me all right?
Yes.
Great. I didn't know if I have to press star 1 to talk or what. Do you want to do the roll call and see if Gustavo or the secretaries joined us, or just them, Melissa? I think
yes.
we know
No. Let me go.
who's here.
Yeah. Right. Let me go ahead and do a complete roll call. Anna Marie Avila Frias.
Present.
Ms. Gallagher.
Here.
Secretary Imbastiani or Ms. Gunn.
Teresa Gunn here for Secretary Imbastiani.
Thank you. Mr. Gunning?
Present.
Mr. Hunter?
Here.
Ms. Johnson-Hall?
I'm here.
Treasurer Ma?
Here.
Director Velasquez?
Present.
Secretary Castro Ramirez? Mr. Prince?
Here.
Mr. Russell?
Present.
Ms. Sotelo?
Here.
Ms. Gordon or a delegate?
Present.
Ms. Miller?
Who's here?
Ms. Patterson?
Here.
And who, may I ask, is standing in for Ms. Gordon, or is that Ms. Gordon?
No, this is Helen Campbell with the Governor's Office of Planning and Research.
Thank you, Helen. Appreciate that. All right, Chairman, we do have a quorum.
Awesome. Full house. Thank you, Melissa. Why don't we go ahead, and everyone had a chance to look at the minutes from the March 17th Board of Directors meeting? Is there any comments or additions or amendments to those minutes?
Mr. Gunning, this is Tia Boatman Patterson, and I think we have the secretary's name wrong in one of the areas. I think we have it as Ramirez Castro instead of Castro Ramirez on page 2. So we'll just make sure that that's corrected.
Perfect. Thank you, Tia. You get that, Melissa?
I have that. We'll make that correction. Thank you.
Great. Seeing no other comments, or are there another comments? Great. Let's deem the minutes of March 17th approved then. Moving on to my comments. First off, I think the biggest one, of course, is to welcome Gustavo Velasquez, who was recently appointed by Governor Newsom as the new director of HCD. Welcome aboard, Gustavo. I think if you don't know, he was a senior director at the Urban Institute in Washington, D.C. He brings to California his federal experience, having served as Assistant Secretary for the Office of Fair Housing and Equal Opportunity at HUD from 2014 to 2017. Newly started last week. Can't tell you how glad we are to see you there. Certainly appreciate you coming in. And again, congratulations to Jack, who has been sitting in for you, but he's also appointed by the governor to serve as Chief Deputy over at HCD. So wanted to certainly recognize both of you and welcome you aboard, Mr. Velasquez. Also, Helen, I know you're sitting in for Kate, and we understand you're going to be doing this, so we want to welcome you as Senior Planner with OPR to the meeting. Encourage everyone to speak up, ask questions, anything that's on your mind. We want to make sure we have an opportunity here, although we're remotely doing this, to make sure the dialogue is just as robust and the discussion covers all areas. So with that, Tia, it's your floor.
Thank you, Mr. Chair. So as you know, the changing the way we do things, this meeting is a perfect example of that, given the COVID-19. We have implemented here at CalHFA a weekly meeting with the leadership team to monitor both the internal and external responses to the situation. The first 2 weeks we did have daily meetings, but those have now turned into weekly meetings. We continue to follow the guidance from Governor Newsom and CalHR on the public health officials. I'm proud to say that the team has been fluid and has adjusted to the adapted as necessary with a very positive spirit. So I'm really proud of CalHFA and its team. I sent a letter a few weeks ago with some details on CalHFA's ongoing responses to the COVID crisis. Most of that information is still up to date, but I do have a couple of updates. I told you that we had posted guidance and a procedure for our development partners or owners of portfolio projects to request hardship accommodations. However, as of now, we have not received any requests for forbearance. Is that still accurate as of this morning? On our single family side, we had some of our lending partners who had stopped offering CalHFA loans, but as more information has come in, we've actually seen some of those lending partners come back and start working again. So it's my understanding that there are now very few of our 132 approved lenders that are not offering the CalHFA loan product. Over the last several weeks, it has become clear that the significant relief that we must have here in California has to come from a federal level. Congress has passed several important bills to assist during the coronavirus epidemic, and Frances Marti, our legislative director, has prepared a visual one-pager that distills the important items in the 4 bills so far, including key housing provisions. The CARES Act put in place important protections for homeowners and renters, gave tools to the Federal Reserve to prop up the municipal market, and provided $12 billion in housing funds through HUD. However, Congress hasn't provided a solution yet to some of the most pressing housing challenges we are facing. For instance, many affordable property owners might struggle soon to make debt payment or cover operating expenses. Struggling multifamily properties would have a chilling effect on affordable housing investors, imperiling future production. It is important that Congress look at comprehensive solutions that we take into account these potential downstream effects. We are encouraged by the scale of the housing proposals that have recently been introduced, the HEROES Act in the House of Representatives, and continue our congressional advocacy to ensure a final package decisively addresses the housing aspects of the COVID crisis. I'm pleased to have Dawn, our Chief Deputy, here to share our strategic business plan and budget for fiscal year 2021. The leadership have put a great deal of energy towards its development. And just when we thought we had finished, the COVID-19 interjected, and with that in mind, we revisited our business planning and made adjustments. Regarding the May revise, we aren't the only ones revisiting our plans. The governor's May revise will be announced later on today. I believe he has a press conference scheduled for noon. We have participated in discussions with the governor's housing team, Business Consumer Services Housing Agency, the Department of Finance to offer ideas that may contribute to the housing needs of the state, particularly now during this pandemic. We've also worked very closely with the Treasurer's Office in making sure that we're moving existing funds. Upcoming events. Many of the upcoming events have been either canceled or have gone to either a live stream or video to be able to meet remotely. And with some of those adaptions, I will be attending a speaking in virtual environments, including the Housing Credit Connect, which I believe we will be forwarding that information to the Treasurer's Office so that if you or your staff would like to participate in the Housing Credit Connect conference, we've also sent invitations to the new Secretary and to the new Director of Housing and Community Development. The Housing Credit Conference Connect will be organized by the National Council of State Housing Agencies on May 26th and 28th and June 2nd and 4th. I will also be speaking May 21st on a webinar for affordable housing and housing finance on the age of COVID-19 put on by California YIMBY. And with that, Mr. Chair, I again would like to welcome Director Velasquez and our representative from OPR to the meeting, and we look forward to the discussion. Thank you.
Awesome. That's great. Any questions or comments from anyone?
This is Stephen Russell, if I may comment.
Go ahead, Stephen.
With regards to hardship, we are tracking here in San Diego. We have weekly meetings with both our forums with our owners, operators, and also with our funders and developers, two separate forums, just to track things like the hardship and rents. And so far, rent collections in the affordable housing sector have been extraordinarily high, much higher than our projections, in 90% plus, when people were expecting it to be much less. What we're seeing, though, is that people are probably tapping out their capacity, and so we expect those numbers to drop the longer that the crisis, the economic side of the crisis continues. But it is really what we're seeing is the non-subsidized, the market rate affordable housing, where people are absolutely getting clobbered and having shortfalls. So that's just an observation from the San Diego region. So you should not be expecting, I don't think that the hardship is going to be tapped into heavily on the affordable side, at least not for a few months, based on what we're seeing here.
Thank you, Steve. Anyone else? Okay, great. Let's move on to item 4, report of the chair of the audit committee. I'm reporting out for the full board of the audit committee, which was held on April 1st, which seems like a lifetime ago, frankly. The agenda for the meeting was to review the results of the audit of the Housing Finance Fund. Mandy Merchant, who's the principal from Clifton Larson Allen, went through her presentation with the audit committee remotely. Of course, that was Delilah and Treasurer Ma, myself. I'm happy to report that the Housing Finance Fund received an unmodified opinion, or as we like to say, a clean opinion, on the financial statements, and that the fund's net position increased by $183 million in fiscal year 2019. Regarding the single audit of our Section 8 program, which was done in July of 2019, this audit resulted in one finding, and for those of you who know, it's a finding we thought we took care of, but it came back. The finding was that 2 of the 8 projects tested did not have the HUD approval for disbursements from the replacement reserve. The management team immediately addressed this issue, and it was corrected in August of 2019. So I think we're square there. That being said, I would like to add that CalHFA's Comprehensive Annual Financial Report, or CAFR, and Popular Annual Financial Report were readily available on the agency's website. If you happen to, the website's very robust, so www.calhfa.ca.gov. There's some other comments I have, but I don't know if any other members of the audit committee would like to say anything. Fiona or Delilah, I'd give you an opportunity at this time.
No, thank you. Very comprehensive report back.
Yeah, no comment. Thank you, Mike.
Great. Anyone else have any questions? Or Lori, I know you're around here. I don't know if you want to add any color to that. Great. No comments. Let's move ahead to item number 5, discussion and possible action regarding a final loan commitment for Redwood Apartments. Ruth, I think you have the floor.
I do.
Excuse me, Chairman. I'm sorry, this is Melissa. I just want to ask that everyone put their phones on mute when they're not speaking. That'll be helpful. Thank you.
Okay, good morning. This morning I'm presenting the Redwood Apartments. It's a project, family project in Santa Rosa, Sonoma County. And full disclosure, I was working from home and I had my script at home. And it's not with me right now. So I am going on memory, which I think is going to work out perfectly. So maybe even better than a script, I'm kind of thinking. In any case, this is a family project in Santa Rosa. And here is a picture of the site. It's currently vacant, and construction is scheduled to start sometime in July. It will be a 96-unit project, and the units will be restricted from 50 to 70% AMI. There are 12 one-bedrooms, 62s, and 24 three-bedroom units. So this is a project that is for families that include large families. And the project, you can see from this slide, is fairly flat and rectangular. And then on the next slide is a street view from Santa Rosa Avenue, which is a main thoroughfare and 4 miles away from downtown Santa Rosa. And here is one more view of the street. And next is a view of the rendering, which is pretty attractive. The project will have also include, in addition to the 4 three-story walk-up residential buildings, a community building. And the community building will include a kitchen, computer room, exercise area, and the site will include a playground and basketball courts and 174 parking spaces. So very well set up for a family project. So to skip over to the financing structure of the project, and sorry I'm flipping pages, you might hear that. What we're requesting today is a permanent loan through CalHFA of $15 million, and that will be amortized over 40 years, due in 17 years. We're also requesting a mixed income loan of $4,750,000, and that will also mature at the same time that the first mortgage matures. There is a bond issuance of $24 million tax exempt and $12 million taxable. And the loan to value for the first mortgage will be 80%. There will also be tax credit equity and a total of $21 million. During construction, I have California Bank and Trust listed as a construction lender, and that's a 24-month loan. Other than that, I think that concludes my report on the project, unless there are any questions.
Ruth, let me make a couple of comments on this particular project. This is one of CalHFA's mixed income projects. I am very excited about this project because it is in a disaster recovery area. Mm-hmm. This represents the streamlined processes that we have come to partnership with the State Treasurer's Office. There was a joint application that was a CalHFA application that came in, a joint application that was made to SIDLAC and TCAC. This project is receiving state tax credits, and it has about $50 million per unit in MIP subsidy. This shows how you can work together, align your resources, and how you can streamline and make things much more efficient. One of the things that we have been doing both at CalHFA and HCD and our partner entities over in the State Treasurer's Office is figuring out ways in which we can streamline and align our resources so that we can jumpstart production. And this is exactly one of those projects that shows doing that. I think from application to construction, it's probably going to be less than 12 months, if not shorter. And these are the kind of things that we want to see going forward. How this project fits in with our sister agency, Department of Housing and Community Development, was that this is a project that stands along some of those projects that are financed by our sister agency, who usually come in and finance things at 50% AMI and below. We had heard for a number of years that there was a missing middle. This, that projects between 50% AMI and 120% AMI, specifically 60 and 80, were not getting financed, even though those are low-income, working-class folks who were living in market rate and being overburdened and cost-burdened. So this particular affordability comes into a very high-cost area in disaster recovery and does exactly what we wanted to do by providing income levels to lower-income working families that weren't traditionally being built. So I am really excited about this project.
Thank you.
Well, if I may add, this is Gustavo, following up on what Tia just said. I'm glad that we are working together on projects like this. I do strongly believe, echoing what you just said, that we have to really pay attention to the full income spectrum of low income, moderate income, and working together on this. I think it gives really a good sense of an appreciation of intervening, for the full less than 30, but also 50 to 70, 50 to 80. So I appreciate those remarks, and I look forward to working to continue the partnership.
Awesome. Thank you, Gustavo. Ruth, anything else? Tia? Any other questions from anyone? All right. I think we need a motion for Resolution 20-09.
Mr. Chair, this is Delilah Sotelo. I move to approve.
This is Preston.
I'll second. This is Anna Marie.
Preston, I think Anna Marie beat you to it.
He always is much faster.
She's fast on the draw. Melissa, would you do the vote, please?
Certainly. Ms. Avila-Farias?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Gunning?
Yes.
Mr. Hunter?
Yes.
Ms. Johnson-Hall?
Yes, great project.
Treasurer Ma?
Yes.
Director Velasquez?
Yes.
And has Secretary Castro Ramirez joined us yet? Okay, we'll pass. Mr. Prince?
Yes.
Mr. Russell?
Yes.
Ms. Sotelo?
Yes.
Chairman Gunning, the resolution 20-09 is approved.
Awesome. Thanks, everyone. Thank you, Ruth. Moving on to item number 6, discussion, recommendation, and possible action to adopt. Yes, who's speaking?
This is Delilah Sotelo. Before we move on off of this, I just wanted to know, is the MIP program, I made a note on this particular project that the affordability that CalHFA is setting aside is 10 at 50%, 10 at 80%, and 75 at or below 120% AMI. So at some point, I would just like, as we report back to the board on the MIP program, just to understand how the regulatory restrictions interface with the actual underwriting of the project, because I do know that all of the units are underwritten at 70% or below, even though the upper edge is 120% AMI. So just when we report back on the MIP program, if we could talk about the I guess discrepancy between what the covenants and the regulatory requirements allow versus what we're underwriting to, that would be helpful.
Ruth, you took a note of that?
Yes.
Okay.
Thank you.
Great, thanks, Delilah. Item number 6, Don, Tim.
Yes. Good morning, Chair Gunning and members of the board. Don Kabir, agency's Chief Deputy Director. And this morning, my colleagues and I are here to present the agency's fiscal year 2021 proposed business plan and operating budget for your approval. The development of the agency's business plan is a deliberative process that occurs over many months. It is a living document that serves as both a roadmap for our business decisions throughout the year and as a barometer of our success. We began our planning process in December, and by January, the agency's senior staff are engaged in multiple all-day planning sessions where we evaluate the mid-year results of the current year business plan, revise our projections, discuss market trends, and vet new ideas for goals and initiatives for the upcoming fiscal year. Directly following the business plan sessions, each department is tasked with the development of a departmental budget that supports the achievement of the goals and strategic initiatives outlined in the agency's proposed business plan. And next, we conduct a board workshop in March to provide a progress report to the board on the current business plan and to outline some of the proposed initiatives for the coming fiscal year. Finally, in May, we submit the proposed business plan and operating budget for your approval. As we discussed in the March board workshop, fiscal year 1920 has been a very successful year for CalHFA despite the unprecedented situation impacting our country and the global economy. However, before I speak to our success, I would like to take a moment and recognize the hard work and dedication and understanding of the CalHFA staff during this difficult time. Additionally, I want to give a special thanks to our support services staff in IT, administration, and our marketing and communications divisions who distinguished themselves during this crisis with a level of professionalism and competency that should make this board very proud. Prior to the COVID-19 crisis, CalHFA did not have an infrastructure to support remote work or a cultural history of telework. Despite this, our IT staff facilitated the required system upgrades and deployment of technology to enable those staff needing to work from home to do so in under 2 weeks' time. Similarly, the admin and communications divisions filtered through an onslaught of information and coordinated with our leadership team to keep staff up to date on the rapidly changing events and sometimes confusing directives being pushed down from a variety of outlets. They did a fantastic job, and we would be remiss if we didn't acknowledge them, so I just want to thank them for everything that they did. In spite of what's been happening around us, as I mentioned, CalHFA's programs have been doing very well. In single family, our program has achieved a third consecutive record-setting year, having already securitized $3.6 billion in lending volume with a month and a half left in the fiscal year. And we are very optimistic that we will hit $3.9 billion by the end of the fiscal year. Similarly, the multifamily lending program has done a great job with the deployment of our mixed income program, which has been very well subscribed and is facilitating production of thousands of new housing units throughout the state. For fiscal year 1920, our business plan was about $500 million in total lending volume is what we were targeting. And the pipeline of projects that we currently have set to close by the end of the fiscal year, whose closings are directly tied to allocations of bond and tax credit deadlines for performance, should allow us to reach $1.2 billion in total lending volume, which represents a new all-time high for CalHFA and multifamily. While there is much to celebrate in terms of the successes this fiscal year, we are moving into uncharted territory as the health and welfare of our communities is in the forefront of our minds, and the impacts of the crisis on our economy have been both immediate and will likely take years to recover from. Thankfully, while we do not have a crystal ball to determine the future, CalHFA is on solid financial ground to help us weather this storm. We will undoubtedly have our pain points, and no one can ever predict every eventuality, but through TIA's strong leadership and the talent and resilience of our agency staff, we have all but eliminated our exposure to variable rate demand obligations. We've dramatically improved the strength of our balance sheet. We've transformed our business processes and built a foundation for the future with experienced leaders and staff. The future is indeed uncertain, but I am confident that this team can navigate anything that's put in front of us. As my colleagues will discuss in a moment, our approach to the 2020-21 business plan can be summed up in one word: pragmatism. Meaning we've eliminated those portions of our lending estimates that are contingent on the availability of future resources for housing. For single family, our estimates are heavily weighted on the most recent production statistics and are both reasonable and sustainable based upon the resources we currently have available to fund down payment assistance. For multifamily projections, our multifamily projections were limited to the pipeline of transactions with hard commitments who have received both bond and tax credit allocations, and whose failure to close within those deadlines will result in a loss of bonds and tax credits for those projects. Of course, we could still have fallout, and we believe we've sufficiently hedged for that. But as we've talked through things, we believe that the more likely scenario is that we will see an effect on our multifamily production revenues, most likely in fiscal year 21-22, after the impact to the overall economy and the state budget is both fully realized, and we have a better understanding of what, if any, future resources will be available for housing. In a few moments, I'm going to turn the conversation regarding our lending programs over to my two colleagues. But before I do, I want to remind the board of the overarching goals that are the foundation of our business plan.
That is fancy.
Yeah.
That is great.
That is fancy.
The first goal is to promote statewide affordable housing production and opportunities for home ownership while maintaining financial sustainability and independence. Our second overarching goal is to continue to improve operational efficiencies through the use of technology, workforce planning, and the implementation of best practices. And third, to collaborate with other housing entities, lenders, both public and private, and stakeholders who complement CalHFA's lending objectives and policy priorities in order to deliver effective and innovative housing solutions. With that, I'm going to turn the conversation over to our Director of Homeownership, Tim Sue.
Good morning, Chairman Gunning, and good morning, members of the board. Good morning. The key thing that we're trying to do in single family is walking that path of promoting sustainable homeownership at the same time as producing revenue for the agency so that we could be a self-sustaining and independent agency. And we do this a variety of different ways. We do this by looking back at what we learned from the past, meaning that era in which we may hold loans and retain the real estate risk. We don't do that anymore. And we also do that by continually, I said in investment backers would say innovating. We continue to expand our menu and expand our eligibility so that we can serve more and more Californians so that they can achieve the dream of homeownership. And that's what drives us. What drives us is to be able to serve more and more people over time by using either different loan products or basically expanding our eligibility. It is very, very true as to what Don said that we had a record banner year in the calendar year 2019. The board might recall that I present to the board at the March board meeting production numbers are based on calendar years, because I think sometimes it's useful to think about numbers in terms of both calendar year and also fiscal year. And it is truly remarkable what we did in the last calendar year. We made more than 14,000 loans. That means that we served more than 14,000 families, and our production peaked at $4.2 billion. Those are numbers that we're extremely proud of. And we worked really hard to achieve those numbers, and you'll see some of the outcomes of those numbers in the next couple pages. Having said that, we are extremely cautious going into the next 12 months and also into the next fiscal year about what we can actually realistically do in this current market. There are certain market forces at play that are, shall I say, bigger than us here in this room. And also certain programmatic changes that we made over the last 6 months or so, which we both, together we think that they are not going to help us achieve these sort of banner numbers that we had in last calendar year. So what are some of the market forces we talk about? So CalHFA doesn't actually have an economist, so sometimes people ask me to play this role.
Unicorn.
So, obviously the COVID-19 induced economic downturn is a complete, I guess to quote someone who says things like this, the likes of which we've never seen. And I think the governor said 2 weeks ago when we were still uncertain about what the unemployment rate is, that he thought that it exceeded 20% already when it was like in the mid-teens. Why is this really important to us? And I don't want to talk about this too much in the sense that I feel like I wouldn't do sort of the enormity of what's happening justice. But why is this important to us in terms of this program? I think you might recall, the board might recall that I talked to the board about the demographics of our borrower base back in March. About 50% of our borrowers are Hispanics. And we also talked about the income band. The folks that we serve, about 95% of them are below 150% of the state's median income. When we look at the mainstream media's reporting about the demographics of the unemployed during this crisis, we can see that it is hitting the colored folks harder during this crisis than the other crisis. So that given whom we serve and given the impact of this crisis on the colored Californians, we do feel that this is a market force that, again, is sort of beyond sort of the scope of the folks in this room, and it's going to hurt our borrower base harder this go around perhaps than those last go around. And one of the things that I find sort of humbling in a way is that these unemployment statistics and ratios, they're not monolithic, nor are they homogeneous. And looking at this particular unemployment ratio and the demographics that's being affected, it's disheartening. And to think that perhaps we won't be able to serve as many people as we did last year and the prior year, but again, these are forces that are beyond what we can do. And secondly is these, in a way, when I say that not to do sort of the enormity of what's happening, I also feel very flippant sometimes thinking about some of these other issues, and they're still with us. Affordability and inventory. These issues seem so yesterday, but they're still with us. We still have these affordability crisis issues in the state that are also beyond sort of what I can do. And we also have inventory issues in the state. Again, these are sort of issues that are sort of now sort of seem like noise, but they're real in terms of what our borrowers are confronting when they're out there. Even if they haven't lost their jobs, they're looking for homes to buy. Affordability and inventory issues come up. Again, it seems like not things that people are talking about, but it's there. And the last issue, which is becoming a very big issue for us, which I haven't at all talked to the board about, is I give it a fancy name called lender engagement. And what I'm talking about is that since March, since this pandemic sort of became something that our leadership at the political level has focused on, since March, we have had 31 lenders who have, at various stages, suspended our program. So we entered a crisis with about 132 lenders. And I may just backtrack a little bit. The board might recall that CalHFA doesn't actually do lending directly. We're statutorily prohibited from doing that. So what we have...
Single-family side.
Yes. So single family side, sorry. I'm having this is all completely on single family. we're statutorily prohibited from being a single-family lender. So what we do is that our program is distributed through a set of approved lenders who have to meet certain standards. We approve them and become a lender, and every year we recertify them to continue to be our lenders. 31 out of our 132 lenders since middle of March have gone through various stages of suspending our program. And I still put this under the market forces and not CalHFA forces, because they have suspended our programs for reasons that are really beyond CalHFA. What are some of those reasons? One is that during the crisis, and now this pressure has eased some, but during the crisis, a lot of lenders were having their warehouse loans be called, meaning that they were the lenders who gave them the warehouse lines are now saying that we want to reduce your warehouse line, or we want to increase the pricing of your warehouse line, and that caused quite a bit of disruption in the marketplace. Another sort of disruption in the marketplace, again, beyond CalHFA, is this conversation about forbearance. While we think that that is a great thing for, let's say, struggling homeowners, that does have downstream collateral damage. Well, and let's say let me not use the word damage. So downstream repercussions in terms of lending, because forbearance and early payment defaults do intersect, and if they intersect in such ways, they may become ineligible for settlement with the GSEs. So some of you might have seen that in the last 4 or 5 weeks, FHFA and the GSEs finally said that, okay, well, a loan in active forbearance will actually purchase into a pool, but they're assessing 5 points for LLPA for first-time home buyer programs, and they're assessing 7 points for non-first-time home buyer programs. So while they are saying that they're eligible for settlement, they are still coming at a tremendous financial cost to the lenders if a loan go into active forbearance before settlement. So those are the kind of stuff that is happening in the marketplace that's causing tremendous amount of noise at the lender level in terms of being engaged with our program. So we've been working really, really hard to explain to our lenders how some of those things are being mitigated through some of the things we can do on our end, and some of which we are also engaged with our servicers, so that we can, if you will, sort of talk some of the lenders off the precipice and then reinstate our programs. So as I mentioned, 31 out of 132, that's almost a quarter of our lenders have gone through these various stages of suspense in the last, since March. And at the moment, that is a lower number, but it's still about 15% of our lenders are in sort of various stages of suspense, either a full suspension, or maybe they're doing just retail and not sort of wholesale. So that is becoming sort of a headwind for us too. So those are sort of the larger market forces that are sort of beyond what we can mitigate some of those forces, but we can't really. There are other bigger players in place like FHFA, like the GSEs, and what they decide to do, we can only react to. We can't really sort of, we can really tell them not to do the things that they need to do. And what are some of the programmatic changes that we've done that also create some headwind to some degree for our program in the next 12 months and also in the next fiscal year? In November of last year, we did increase our FICO score minimum from 640 to 660. And as I mentioned earlier, we are walking this path of hoping to promote sustainable homeownership. That's very important to us. That's one of the huge lessons learned from last financial crisis. And what we notice is that as we're starting to get more data about our production, our recent production, what we notice is that FICO band between 640 and 660, that the delinquency ratio for that FICO band was about 2 to 3 times higher than above 60, above 660. So it is true, on the one hand, that we perhaps won't be able to serve the folks in that sort of FICO band, but what we hope is that, if they get more financial literacy and put more effort into increasing their FICO score and sort of be aware of the issues that are involved in homeownership, we're happy to serve them. FICO scores, as you all know from looking at the internet, is a number that can be improved with some work. And in March of this year, we also made some changes to our DPA program so that for a certain population, our DPA is now capped at $10,000. And then last but not least, in May of this year, we also decreased our DTI requirement from 45% to 43%. We did that for a couple of reasons. As the COVID-19 induced disruptions in the marketplace was kind of rippling through, a lot of lenders were tightening their credit boxes in reaction to what was happening and what's to come. We did that to reflect sort of the overall lender tightening of credit boxes and underwritings, yes. But our ability to offer the 45% DTI versus 43 is also sunsetting at the end of the year. It's what's referred to as the QM patch. That sounds really sort of jargonish, but what that is that a loan made by a lender at 45% DTI is considered to be a non-qualified mortgage if it's not done with the GSEs. And I think that the market expects that patch would go away at the end of the year. So we kind of took the opportunity to make our DTI qualify with CFPB's requirement of 43 a little bit earlier in the middle of this credit tightening, but that was the only change that we made, if you will, in response to this COVID-19 induced disruption. Our production target for this coming fiscal year is the same as last year.
Tim, can I interrupt for a quick second?
Sure.
It was a little bit of alphabet soup for folks, so are there any of those acronyms that you can break down or that are important to break down?
Sure, sure, if I can. Sometimes I forget what they stand for myself. So
just more programmatically, I guess.
So I believe that CFPB stands for Consumer Finance Protection Bureau. So in the aftermath of the last financial crisis, CFPB instituted a bunch of rules on both disclosure and also rules regarding mortgages that are deemed to be qualified mortgage rules, and they exempted GSEs for a variety of things, and one of the key things that are exempted GSEs, which is governmental sponsored enterprise. And that includes the likes of, let's say, Fannie Mae and Freddie Mac and Ginnie Mae. That's not acronyms, right? So anyway, the key waiver they gave to Fannie Mae and Freddie Mac was a 2 ratio higher DTI from 43 to 45.
Debt to income.
Debt to income ratio, DTI, debt to income ratio, sorry. So that exemption is colloquially referred to as a QM patch. QM stands for qualified mortgage. So if you look at QM patch on the internet, you actually find that. So anyway, that's sunset at the end of the year, and we knew that at the end of the year we would have to get rid of, decrease our debt to income ratio from 45 to 43 anyway. And we kind of took this opportunity in the middle of all this to do that. And you might wonder, I'll speak to this point when I'm playing my other hat later on and speaking about finance. You might wonder, why is there a need to do that? Why are we preemptively doing that? And the main reason for that is that we have certain partners in the financial markets that we need to also keep in the mix if we want our programs to be successful. And what I mean by that is the key player that we have as a partner in the lending space is our servicer. And you may or may not be tracking sort of all the disruptions in the servicing space and in the mortgage hedging space in the month of March or April. But there was a long period of time, and it's still true even today, in which the disruption in the servicing was referred to as SRP. So it's servicing release premium. There is a tremendous disruption in the SRP pricing place because now all of a sudden it's actually costing the servicers money to service loans. And what I mean by that is, these are all interrelated issues. So if the servicers have to grant the homeowners forbearance, that means that the servicers actually have to come out of pocket to advance those payments so that the mortgage-backed security holders, I'm trying really hard not to use acronyms, mortgage-backed security holders will still get their payments. So then all of a sudden, there's a tremendous disruption in the SRP pricing space, and the tightening of the credit boxes is something that our servicers like, because they feel that now we're dealing with a better credit box so that they wouldn't have to reduce what they pay us for SRP as much as they would have to do with, let's say, other, programs. So then the tightening in the credit box is not something that we control on our own because we have these sort of key players in place. And then related, these are sort of like completely related in different ways. And you might say that, well, why do we need servicers, outside servicers? Because why can't we find some other servicers, or why don't we service ourselves? And that's related to the issue that we no longer own the real estate risk of these loans, which is sort of related to the issue about we're doing things differently now than we did, 15 years ago. So, Delilah, is that helpful?
I think it is. I think it helps give context to what we're talking about.
Okay.
And look at it from a policy standpoint.
So then I'm going to sort of go into sort of the numbers a little bit now. So our target business production number for 2021 is also $2 billion, which is the same as last year's. And on the surface, someone may say this, and I guess I'm preempting the comment. Someone may say that, well, gosh, you did $4 billion last calendar year, and as Don said earlier, we're projected to do nearly $4 billion in this fiscal year. Why are you producing a target that's so low? And then I think, as Don mentioned earlier, that we are very focused on our recent reservation numbers, and I think that some of the programmatic changes I talked about early on are real. So like when we increased our FICO score from 640 to 660, we did definitely see a production hit. And these impacts on DPA and also the 45 to 43 are more subtle, but they are resulting in real changes. So for the month of April, for example, so in production, we keep track of monthly production numbers in terms of reservation locks and also securitization, but we also keep track of them from year to year, so which is something that, as you know, corporate folks like to do a lot. So we compare the April production numbers in terms of reservation to the April 2019 reservation numbers. So when I do that exercise, the April of 2020 reservation numbers are 30% lower than the April of 2019 numbers. And although May we haven't seen a whole month of May, if I were to extrapolate the May reservations numbers that we have versus the May number in 2019, I'm projecting about a 55% decline in terms of reservations. So we're not at all trying to put in a $2 million target and then come in at $4 billion. That is not our goal. And we just think that some of the changes that are happening are real, and then when we look at May, we look at April, they are finally coming through in terms of impact on our production. And again, those larger market forces at play that are beyond our control are also out there. So the $2 billion target will result in about $30 million of revenue to the agency. Our down payment assistance, I'm going through the bullets now on this page. Our down payments assistance is very tied to the first loan production that we do. It's really the oil that kind of makes the machinery work. It's about $67 million. The Zero program, which is our which is our closing cost assistance program, more people are availing themselves to that as rates are at historic lows. I keep saying historic lows, but this is truly now the historic low, and until perhaps next year. We think that we might do about $40 million of those ZIP loans. Again, these are for closing costs. Last year, we launched a disaster program. And for better or worse, it's not extremely successful for now. So one of the things that we're going to do to modify our disaster program is to marry our disaster program with the FHA 203H program. So what that would do is that it will make the FHA loan go up to 100% DTI rather than 96.5 DTI, loan to value. Sorry. And what that will do is that if we marry that with our disaster program, then people who avail themselves to our disaster program could get a 100% LTV loan from FHA and then use our down payment assistance program for closing costs, so they can really get into another home without any money down. So that's an enhancement that we're thinking about this year. This next one here on Fannie Mae upload process, this has a fancy name. All that is that all the lenders out there have a data format that's complying with Fannie Mae's data format. And what we did a couple of years ago, and this is sort of like the beginning of a sort of somewhat of a mini revolution in terms of our systems, is that we created uploading mechanisms so that the lenders can upload these sort of industry-wide formats onto our system instead of having to come to our system and then rekey everything again. And rekeying everything usually creates a lot of data mistakes. So we have a lot of data integrity issues that are being solved by sort of being able to interface with these industry-wide data formats. Keep Your Home California. We just got our final audit from Treasury last week, and we had a really clean audit. There were two small minor findings, and the sweep is expected to happen in a couple weeks, and that all the sort of the management of the liens and servicing is transitioning to our loan admin group headed by Rhonda. And the the one thing I'll sort of make note of is that these are sort of like the high level things that we're thinking of doing, but there's sort of a myriad of little smaller projects we do along the year. And last but not least is that we're embarking on an OCR, optical character recognition project. It's referred to as OCR, but it's a lot more than that. I think that OCR software has been around for a long time. What people have been doing in the last, I think more so in the last 5 years or so, is to marry the OCR software with what they call artificial intelligence software, which I have my sort of personal reservations about that, but just marrying OCR with software to make it so that you have less and less people who are doing what I call sort of stare and compare, meaning that the software is able to tell you where the variances are, and then staff are simply solving for discrepancies and not trying to figure out where the discrepancies are. So we think that this kind of sort of systems implementation will really truly help us scale better when we see productions go up to $4 billion or come down to $2 billion with some IT help. It will help us sort of scale up and scale down easier. So next slide. This is a sort of a quick tabulation of our goal from last year, our goal this year, and also what our revised expected number for this year to be. So our goal last year, as I mentioned, is $2 billion. It is still $2 billion this year. As Don mentioned earlier, we expect to do $3.9 million in the fiscal year. And then below that, you see the corresponding subordinate loans that we would make with those firsts. And then on the bottom half of that page, you also see the revenue generation from those production numbers. You can see, again, the 2019 and 2020 numbers are sort of banner record numbers that we truly do not expect that we have the ability to replicate that. And the one thing I would also add to what Don said earlier is that, and I kind of alluded to this briefly, but I want to tie the two threads together, is that our program is most definitely dependent on down payment assistance, and this is a point that I sort of talked about before. When Don is talking about having the resources to achieve these numbers, in large part, I believe he's talking about us having the down payment assistance resources, availability of down payment assistance dollars and funds to be able to achieve these numbers. And we do have sufficient down payment assistance to achieve these, this $2 billion number that we're looking at here on this page. And on the next page, this is a historical view of our production numbers. So in the lighter blue, what you're seeing is the actual target that we have put in place when we've done our budget exercises. And you can see that in the beginning, it is true that we were exceeding those numbers by some, but in the last couple of fiscal years, we have been exceeding them by a lot. And this year, we're proposing $2 billion. And the dark blue line that Don is showing coming down, that's to be determined.
Right.
Right.
That's just the intersection of our budget and where we think we are.
And we think that it would be nice if we are more than $2 billion, but I really do not expect us to end up with $3.9 or $4 billion like we have in the last couple of years. And to be sure, in those couple of sort of years, of like 19 and 20 and 18 and 19, we were also going through the down payment assistance resources really, really, really quickly. So said a different way, many of you, I know, since Mike said that April 1st seems like a lifetime ago, you might recall December of 2018, in which we went to the ballot and voted for SB 3. And with the treasurer's help, we were able to access those SB 3 dollars in second quarter of last year. And we received those dollars from HCD in June of last year. And we got $150 million out of SB 3. I believe we only have about $20 million left out of that SB 3 dollars.
Yeah.
So these...
This is Lourdes. I have a question. Hello?
Yes, Madam
Yes.
Chair.
Go ahead.
Yes, so I have a question, and also just wanted to inform my fellow board members that I won't be able to stay very long. As I think many of you know, today the governor will be releasing the May revision to the budget. But I did have a question regarding the homeownership, the overall plans for this upcoming fiscal year. So in light of what has been already shared in terms of what our goals are, and also the impact that COVID-19 is having economically, and how disproportionately it's impacting lower income, people of color, I'm wondering if you all have also factored in how to help homeowners stay housed, right? So there's been great progress made in terms of getting families to owning their home, and it sounds like there's a continued effort to continue to do that with appropriate down payment assistance and counseling. But as we go into this, for the next, as was mentioned earlier, right? For the next few years, we're going to be, continuing economically to to be strained. And so I'm just wondering if you all have factored that in.
So in the short term, the CARES Act has created a right for homeowners to ask for forbearance. And when we survey the servicers out there for single-family homes, they're granting forbearance without hardship. They're granting forbearance without documentation. So I believe that CARES Act accommodates 6 months plus another 6 months, so a total of 12 months potentially of forbearance. So that means that they don't have to pay principal, interest, and taxes and impound at all for up to 12 months. Having said that, I believe that the actual implementation on the ground is they are granting 90 days or 3 months at a time. So then after 3 months, if you were to ask again, you can get another 3 months. So then from the standpoint of sort of the currency of what's happening today, I think they are getting relief. But what I think is a bigger issue, which I think most of the folks who are in the space are guessing about, is that of the forbearance that are given. So by the way, when we look at our legacy portfolio of our whole loans, our forbearance ratio is almost 5%. So almost 5% of our single-family whole loans that we own are under forbearance. So the true question here is that what's going to happen at the end of the 12 months? Mm-hmm. What's going to happen when some people are, let's say, just like the last crisis, now have a job that pays less? Or let's say now somehow have only one person out of the two-person household actually re-employed. I think that's the bigger question in which I don't know if anyone has any sort of great ability to project. Having said that, the servicers that we talk to, many of them are actually quite sanguine about the ability of many of these homeowners to pay when this is over. So, but again, that's sort of like the big unknown. But meanwhile, it's as if you're transferring that financial risk from the homeowners to the servicers. So then you'll see that there's tremendous amount of activity in the servicing space in terms of lobbying and in terms of also facility from the feds to help the servicers so that they could also get a little bit of assistance as they're assisting the homeowners.
Yeah, I would just suggest that because there's so much unpredictability, as mentioned, that to the extent possible, if we can, as a board, maybe receive more sort of regular sort of updates in terms of not just the budget, but the overall goals that we establish for this fiscal year, right? And maybe an opportunity to determine whether some readjustments need to be made, in light of the situation, because there is a lot of just, unpredictability. And so, yes, that would be my recommendation and ask.
Awesome, thank you. Tim?
Okay, so moving on to the next page, the menu of loan products and clients. Given how much time I've taken, I won't go into this too much. I know that there's must-see TV at noon. What this is what all this is. All this is that it's me somewhat bragging to the board, if you will, that over the years since we launched this program in 2013, that we have been able to, the phrase we use here sometimes is that to be more things to more people over time. We have been able to expand our eligibility, as I alluded to earlier, and also increase our product offerings. And all of that is something that we need to do both as a self-sustaining entity from the standpoint of production, but also we are very much a governmental entity with many stakeholders. that are interested in also expanding housing in different ways. So this menu here is sort of a demonstration of that. And some of it are more successful than others. As I mentioned earlier, our disaster program hasn't really gotten much traction. That's why we're continuing to sort of refine it. But others, like manufactured housing, that actually has gotten quite a bit of traction. And leaseholds, albeit we only have a total of about 22 out of those. That's not so bad when you consider just the amount of activities in that space. So that's my presentation, and I'll happy to take more questions if anyone has more questions.
Tim, this is Tina Johnson Hall. I was just on a call earlier this week, and they were just talking about with the CBA group. I'm sorry, I'm using acronyms too. Consumer Bankers Association. And basically, they were talking about the mortgage industry and some of the things that they saw on the immediate horizon. And just wanted to confirm that everything that I heard you say was elevated in those conversations and then some. One of the things that I am concerned about, besides sort of the kick the can down the road challenges for some of the prospective homeowners, existing homeowners that you so accurately described, is with the tightening credit environment, I actually think that there will be a need for an increased demand for DPA or down payment assistance. Immediately, what some of the challenges, besides increasing the FICO scores that is already happening, there are a number of lenders now that are increasing the down payment, even for those that they've already issued letters out to. So I actually see that there might actually be a run on additional support for DPA on the immediate horizon, assuming, as you noted, that they can find with the inventory crisis, people pulling their homes off the market as an example due to COVID. I do believe that there might be a run for on additional DPA. I'm just wondering, have you thought about that the fact that some of the conventional lenders are going to immediately change their thought process because of the tightening credit environment around down payment and what that would look like for potential consumers over the next 6 months?
I totally agree with you. Not to throw any sort of bulge bracket banks under the bus, but I thought JP announced a couple of weeks ago that they were not going to do any lending without sort of a higher than 80% LTV.
Yeah.
So I think that that's a glaring example of as you say, that the banks tightening their credit box in such ways that they'll effectively bow out of the first-time home buyer market, or let's say higher LTV market, without doing so directly. And as such, we would sort of serve a larger clientele that otherwise could be banked by JP, for example. Here's the bottom line. The bottom line is our program going to be more relevant during the financial crisis? Absolutely. I totally agree with you, Tina. I mean, the $4 billion that we did last calendar year, I mean, if you track, at the March meeting, I talked about this. I didn't really talk about this today. Our market share over the last 3 or 4 years is creeping up. We're now close to, possibly close to 10%. And in the state. And I think that we will be more relevant in this particular crisis than ever. And that's part of the reason why that sometimes me wearing 2 hats is not a bad thing, because I'm also very, very protective of this down payment, down payment assistance resource that we have. And we do everything that we can to also not just protect it, but to recycle it, and then to also, SB3 was also an effort on our front, TIA and us to generate more down payment assistance to serve the folks in California. So absolutely, I totally agree with you.
glad to know that you're thinking about it. Keep wearing two hats, Tim. We need you there, right in that spot.
Right. Right. Oh.
I do have a question about, Tim, the disaster victims fund. You said it was not well utilized.
Mm-hmm.
So can you just explain a little bit about this fund?
So what we did was that in September of 2018, I believe. I'm not sure why I remember that, but September 2018, we came to the board and we waived the first-time home buyer requirement of our down payment assistance program for disaster victims. So then we basically said that you don't have, so all our programs, you are required to be a first-time home buyer. So then we used to check people's mortgage interest deduction, but now since mortgage interest deduction is now gone, we now check to make their credit reports to see if they actually own a home in the last 3 years. So we waived the first-time home buyer requirement for that population. I believe that is not very effective because the lenders don't think of us as a non-first-time home buyer program. Because for a disaster victim that has home or perhaps sort of equity or whatnot, most of the lenders will sort of, steer is a bad word, but they'll guide them to their in-house products and not use our products because they still make more money when they use their in-house products than when they use a product with us. Because when they use a product with us, we limit all sorts of fees that they can charge and whatnot. So they do still like their in-house products better. So then, sort of my goal is that we continue to make that more attractive. So like as I mentioned earlier, that if we do this 203H, then we can go up to 100% LTV. But on the flip side of that, it's not clear to me either that disaster victims who are homeowners, that whether or not they need that kind of high LTV financing. But what we have also allowed in this program is renters. So then if you're a disaster victim and you're renting, then let's say Sonoma, for example, you could actually avail yourself to our program. So then that could be more relevant for that renter coming into our program who is not a first-time home buyer, who is a first-time home buyer, sorry, who didn't own a home that he lost or she lost. Then let's say an existing homeowner in Sonoma buying a second home coming to us.
So we also are in the process of preparing emergency regs for our disaster. Funding that we got through Congressman Thompson's office, and maybe there's some synergy or something that we can work on to get the message out as we are working with
Some
those
kind of marketing.
developers, in the
marketing.
13 counties.
Okay.
So I mean, but right now, a lot of our counties are part of our program. Because what we did was that we took FEMA's major disaster declaration counties and included into our program for the last 3 years. So quite a few counties. So yeah, we need to continue to work on that to make it more and more relevant.
No, yeah. We can definitely work on a joint marketing kind of campaign.
Chairman Gunning, this is Lynn Von Koch for standing in for Secretary Castro Ramirez. I just wanted to let you know
Hi, Lynn.
join the call.
All right, thank you. Tim, anything else or any more questions from board members?
This is Eileen Gallagher. I have a quick question. The trends you talked about to make sense, it sounds like there's two forces at work, the economic consequences of the pandemic, obviously, and then the changes to our program. Of the 30% decline you're seeing so far in reservations through kind of April, I guess, early May, I wasn't clear on the timing of when our changes went in versus when the kind of pandemic kicked in, how you split those. Are those two completely tangled, or do you have some sense of the relative impact of either?
So the FICO score was November last year, and when we put in the higher FICO score, we saw a fairly significant hit on our production. It was about 25% or so. And so you might argue a significant amount of that decline in April is sort of like the tail of what we did in November, since I'm comparing April 2020 to April 2019. The DPA changes that we made were March of this year, so April probably started to feel some of that a little bit. But what that did was that it kind of it limited the DPA we supply for the higher loan amounts that we have. So our average loan size is about $300,000. So at 3.5% of $300,000, it's just a little bit more than $10,000. We put the cap on $10,000, so it really didn't affect anybody who was buying lower than $300,000. It was for the higher loan amounts. And then the LTV, the DTI, the debt to income ratio, we didn't do that until May 1st. So the April numbers didn't see that yet. But I think that in May, you're starting to see all those things kind of come into play. The DTI is in place in May, and then the COVID is in play, the DP is in play, and then we're still sort of, you might argue that we have intentionally in sort of supporting sort of the idea and also the reality of sustainable ownership, that FICO score is also something that's coursing through our production.
Any other board questions on a single family? All right, not hearing any, I'm going to ask Director of Multifamily Programs, Kate Ferguson, to talk about multifamily programs.
Thanks,
Yeah,
Bob.
I will try to be efficient in my comments today because I know everybody's looking at noon, which is hovering right above us. I'm excited to be here today, given it was a May board meeting last year when I was appointed by the board and then sworn in by Treasurer Ma. So I'm approaching my 1-year anniversary with CalHFA, and it's been a very good year. We're planning for expected opportunities and lots of challenges in the next fiscal year. So with the next slide, I'll just talk about goal number 1 for all of us. And as Don stated, our overarching goals for fiscal year 2021 are the foundation of our business plan. And the multifamily team remains focused on increasing production and ensuring preservation of the affordable multifamily housing stock in the state of California. In fiscal year 1920, we widened our focus to incent mixed income housing production via our mixed income program, or MIP as we call it, which was originally rolled out in the form of an OFA in the spring of 2019 and then modified to an over-the-counter program for 2020. The 2021 bar has been set high with the expectation of another $1 billion in lending volume, supporting the development of over 3,500 new units. This production will include renewed energy towards expanding our conduit issuance program to smaller communities where we can add value. We will continue to work through our portfolio of maturing projects to ensure affordability restrictions remain in place and to capture refinancing opportunities as they are available. The first availability of recycled bonds is expected to come out this year via our new recycling program, and that will add resources to the market in a time of increasing need. So hopefully that will give us some flexibility to address some of the upcoming need we're expecting. Not as exciting as new production, perhaps, but equally important to our group will be our continued transition of the multifamily asset management database and activities to a new system under the expert guidance of our Deputy Director of Multifamily Programs, Andre Massey. This transition will ensure that our ongoing focus on managing the portfolio with a high degree of efficacy and efficiency continues to improve, and that our ability to measure outcomes increases. The next slide, and I'm going through the numbers and everything quickly. So the next slide shows you our numbers for the year and our projections for 2021. This slide reflects some good news and a lot of hard work by the multifamily staff. As you can see, production levels for 1920 far exceeded expectations. Our revised year-end production goals reflect lending volume, which is approximately 2.5 times original goals. Lending volume growth was driven by our conduit issuance business, which grew exponentially in 1920, as driven by the mixed income program. Strong conduit issuance business is expected to continue in 2021, although at a slower pace. We have been conservative about projections for 2021, given current economic stresses, and only production which is currently in our pipeline is included. Overall, the 2021 conduit business is expected to fall to a more normalized proportionate share of both lending volume, falling from 89% of lending volume in 1920 to 68% in 2021, and also revenue falling from 40% in 1920 to 26% in 2021. The 2021 permanent subsidy commitments also take a 69% jump as permanent loans related to the MIP project currently in the pipeline move to the final commitment phase. Before we leave this slide, I want to point out the increased lending and revenue projection numbers for the SNP program. In 2021, we continue to wind down that program, and we will continue to close the tail of the pipeline of those deals with the closing of all related loans that have to be done prior to the end of the fiscal year 21-22. This next slide shows the previous numbers in the form of a graph. It clearly tracks the successful achievement of lending volume in 1920, exceeding both budget projections and fiscal year 18-19 actual. As previously stated, our numbers for 2021 remain robust in spite of our conservative estimates. Based on our recent history with the MIP, if the previously committed SB2 and AB 101 resources for this program continued to be available, there's potential to exceed the $1 billion number reflected here. Given the current COVID crisis, we have conservatively estimated very nominal growth per MIP in 2021. The next slide shows you our multifamily volume by type. Just wanted to point out that the large proportionate share, it points out the large proportionate share of our overall production volume that is from conduit business, 89% in 1920. We expect this percentage to fall to a more normalized level, as I said, of 68% in 2021, as actual loans related to the conduit MIP business move to the final commitment stage. On the next slide, this is the slide everybody usually likes because it talks about the volume in the housing units. It reflects the impact. This slide really reflects the impact of all this business. Production of new units, based on current estimates, 3,960 units will result from 1920 production, with another 3,500 units expected in 2021. That's almost 7,500 new units, which should begin production in the next 12 to 18 months, and we can all be proud of that. The next slide shows our results for 1920. As stated, our growth has been driven in large part by MIP. Our first 7 projects financed as part of the MIP 1.0 NOFA will provide 1,296 units. 4 of these deals have already closed their construction financing and are out of the ground. An additional 13 projects have received preliminary approval from CalHFA and an allocation of bond cap from CIDLAC in the MIP 2.0 round. These projects will produce another 1,933 units for a total of very close to 3,300 units, 3,299 new units with an average 60% AMI, which should be out of the ground by this calendar year end. We've talked a lot about MIP today, which is important because it's driving a lot of the increased revenue and production numbers. But I also wanted to assure the board that CalHFA continues to provide permanent and subsidy financing for a variety of other projects throughout the state. I thought I'd highlight one that we just got approved this week, which is a great example of the partnership of many different players in the state. The deal is Dorgon at Chinatown, which Mr. Prince should be very familiar with. It'll be a new project developed by the Fresno Housing Authority. I picked this project to highlight because it will result in the development of 57 units available to households from 30 to 60% AMI. Even though it's not a MIP project, that's a mixed income project, if you ask me. It's also a mixed-use property with ground floor commercial space to be used for program services and retail. CalHFA will be doing a $20 million conduit issuance on this deal, and the capital stack layers a $1.9 million CalHFA perm loan and a $775,000 CalHFA earned surplus subsidy loan with federal and state tax credits, IIG funds, City Home Funds, TCC Housing Fund, and TCC Infrastructure Fund. And I know that's a lot of acronyms. I apologize for that, but Those are the names of the programs.
So,
I'm sorry?
Kate, let me, the TCP, I believe those were the transformative climate, the catalytic funds from SGC, is that correct?
Yes, that's true.
So this is a alphabet soup of layered financing. So you have financing from SGC for climate change, transit-oriented development, infill infrastructure grant, local federal dollars, and state dollars, all in this project. And for the Central Valley, they need that kind of gap and some of these resources to help projects work in there. But this shows how the state and the federal government and the tax credit allocation committee and CIDLAC have all been working together to align those resources to make projects come to fruition. So this is an example of one of those alphabet soup projects that we're receiving a variety or broad range of incomes in an area of California that is much in need of housing. And Mr. Prince, did you want to add anything about this particular project?
No, I think you all covered it really well, so thank you.
Can I ask a question about the...
I'm sorry?
This is Stephen Russell here, Kate. Can I ask a question of the proposed budget for the mixed income program moving forward? That's, how sensitive are those sources? I mean, is that a reliable projection?
How reliable are the projections? Is that what you're asking?
Yeah.
I think we'll know after 12 o'clock, Mr. Russell.
Projections are just based on what's in the pipeline right now. So we'll have fallout and we'll have more new deals, but we feel like we were very conservative. So that's based on where we sit today.
Yeah, Mr. Russell, this is Don. I was just going to comment that the projections that Kate is talking about are deals that we have the MIP dollars in hand and have, these are transactions that have bond allocation and tax credit allocation. So there's nothing in the projection that extrapolates beyond the resources in play currently.
Right. So I'll go quickly to the next slide, which is opportunities for 2021, which might seem like a crazy slide to have. We don't know where 2021 will take us, but I can tell you I'm confident that we've built an infrastructure of affordable housing professionals to manage whatever market demand and whatever market need we see next year. The new construction market will remain active. Demand will be driven both by resources available in the commercial real estate market, neither of which we have control over. We're working to develop new partnerships within the state housing circle and within the industry. And the rollout of our bond recycling will hopefully be a new resource that we can bring to the market during this time. Finally, our final slide is challenges for the next fiscal year. Some major market drivers were putting stress on the industry long before COVID-19 showed up. The fierce competition for finite resources in the form of bond caps, state tax credits, and funding for state housing programs will continue to be areas where CalHFA has the opportunity to be creative and collaborative with our state partners, our county and local, and also at the county and local levels. The realities of the impacts of the pandemic will result in the fallout of some deals already in the development pipeline. Lenders and equity investors have pulled out of the market. They've pulled out, they've come back in, they've pulled out again, putting deals which were near closing at risk now. Pricing and costs are increasing when gap funding is decreasing. The realities of the market are difficult right now, and our projections are reliant on an abundance of external influences over which we have no control. So we'll be as nimble as we can and as efficient and cost effective as we can to ensure we can play a positive role in whatever the next fiscal year brings us. And with that, I'd be happy to take any questions, and I know we're almost 20 minutes before the governor speaks.
That's pretty thorough. Anyone have additional questions or comments? Well, Don, Tim, Kate, thorough presentation.
We still have more. I'll run through it quick.
Can we do it in 10
I know
seconds?
you got more. Go ahead, Tia. Do you have a thought?
I was going to tell him to do it in 10 seconds.
Okay.
Yeah, I know.
If I got to do it in 10 seconds, I'll tell you that from a financial health standpoint, I think that the organization is probably in as good a financial condition as it can be to deal with all these unknowns. That being said, like I mentioned at the beginning, we still have a lot of variables in play that we're going to have to navigate. Our credit ratings are up. We're going to continue to work to maintain those and continue to improve them. I think we're obviously going to continue our efforts to create new operational efficiencies throughout the organization using technology as our bridge. We're going to continue our efforts to create new partnerships that help us further the mission. And we're actively working on some that we hope to bring to the board in the next few months. With that, do you have any questions on the business plan? Hearing none, I'm going to move to the budget. I'm moving quickly. Revenues are... Is there a question?
No, go.
Okay. Revenues, we're anticipating $70 million in revenues to cover operations this fiscal year. Unlike prior years, this fiscal year, revenues generated by current lending activities is going to cover the entire organization's budget. We're not using any legacy revenues to deal with the agency's budget, so that's great news. We anticipate the annual budget, the budget we're submitting to you is $39.6 million. We anticipate having about $30 million in surplus funds that we will deploy as capital reserves to help pay down debt and continue our efforts to strengthen the balance sheet. $25.7 million, it's really people and salaries and benefits is the main part of our organization's budget. Operating budget's just shy of $14 million. On a year-over-year basis, the agency's budget before you today is a 5% reduction over prior year. The lion's share of that being from salary and benefit, anticipated savings from salary and benefits. As many of you know, you've heard my speeches before, our organization is extremely lean, and we have approached our budget always with an eye on being the most efficient in how we deliver our programs. And I think from a position standpoint, we're recommending no changes in terms of agency headcount, but as you can see, we have systematically reduced our reliance on staff and have utilized technology to sort of bridge a lot of what used to be very manual activities and processes within the organization. We're currently always keeping an eye on the need to recruit and retain new staff and to deal with succession planning issues as we go forward. And as I think we think we are appropriately staffed to deliver on our current business lines. However, as we get asked to do more and more things that sort of transition out of our core businesses, we'll need to reevaluate that and come back to the board if we decide that we need additional staffing to sort of stand up any new activities. And with that, are there any questions?
Good job.
Really good job. 221 total employees, Don?
That's the full-time headcount, and we have a couple of temporaries as well.
I saw that. Okay.
Dawn, this is Anna Marie. I just had a quick, hello, this is Anna Marie. Just had a quick question. I know the governor just announced as well that there's going to be cuts at the state level for employees of 10%. How is that going to impact CalHFA?
I think we would have to wait to find out about that. I do know that at least there's some historical precedents surrounding furloughs and CalHFA and other entities that have a level of independence, and I believe there was a lawsuit that the state lost during that. So I think it's to be determined as to how it actually ends up affecting us. But obviously we're going to be keeping tuned to what it is the governor is desiring to do and then react appropriately.
Gotcha. Thank you.
Good question. Any other questions from the board or board members? All right, I think we need motions to approve? We have 2 resolutions.
I move, Fiona.
Is there a second?
Second from Tina Johnson Hall.
Is that for both
Yes.
resolutions?
Yeah, both resolutions.
Perfect. Melissa, roll call?
Okay, so on this roll call, am I doing a roll call for both resolutions at the same time, or should I separate them?
Yes, ma'am.
All right, so roll call for resolutions 20-10 and 20-11. Ms. Avila Farias?
Yes.
Ms. Gallagher?
Yes.
Ms. Gunn?
Yes.
Mr. Gunning?
Aye.
Mr. Hunter?
Yes.
Ms. Johnson Hall?
Yes.
Treasurer Moss?
Yes.
Director Velasquez?
Yes.
Ms. Von Koch-Liebert?
Yes.
Mr. Prince?
Yes.
Mr. Russell?
Aye.
Ms. Sotelo?
Yes.
Chairman, resolutions 20-10 and 20-11 have been approved.
Awesome. Thank you, Melissa, and thank you, everyone. I want to draw everyone to...
Mr. Chair?
Go ahead, Tia.
Regarding
Yeah.
item 7, reports, those are usually just filed and for the board's information, but there was a couple of things that I wanted to point out, if you don't mind, if I take about 30 seconds to do that.
I was just going to give you that 30 seconds.
Thank you, sir. Under item 7C, conduit program issuance, and Board Member Sotelo would probably be delighted to see this, but it starts on page 143 of your board packet. For the last 5 years, we have been working with the City of Los Angeles to help them with their backlog of conduit issuances. And we have negotiated a memorandum of understanding with that city to be able to provide those conduit issuance services. Although we did not need an MOU, it was important for the City of Los Angeles so that they could be able to not have to take conduit issuances or waivers to their city council, so it provides them a certain level of protection and assists them with their backlog. Some specific terms of the MOU. It would be applicable for, CalHFA would serve as the conduit issuer within the City of Los Angeles for bond issuances of less than 15 million, where there were no local funds. It incorporates local accessibility covenants, and the initial term is a 3-year term. And literally, we started negotiating this in May of 2015. So it is nice to see a state-local partnership that's coming to fruition, and it may be able to serve as a model as we work with other local jurisdictions in building our conduit issuance program. Also, I want to bring to your attention the other, thank you, the other asset management quarterly portfolio report. You know, this is something that we started doing regularly to give the board updates. So if you want to take a look at that quarterly management portfolio report and have any questions of multifamily staff, please do that. But those are the 2 big things that I wanted to bring to the board's attention.
Thank you, Tia. I'd also just like to highlight the work that Frances has done. He has the COVID-19 legislative update that starts on page 166. Very good summary of the bills going through the legislature this year. And then I'm pretty sure it was attached, but he also did a great update from the CARES Act and the impact on housing. So I think that was included, correct me if I'm wrong, Tia, but that's also a very good document to see the federal stimulus money and how much of it's related to housing. It was very helpful by Frances.
Right, and lastly, we do have a mixed income report update that gives you a summary of all of the mixed income projects that have received bond and tax credits, and I know we need to get Board Member Sotelo back that information about underwriting and the average AMIs of those developments, so we will do that.
Yes, I'll follow up directly, if that makes sense. Yes, this is Kate.
Yes.
Okay.
Excellent. At this point, we'd like to open it up, operator, for public comment and give members of the public an opportunity to address the board members on matters within the board's authority. Anyone from the public wish to comment?
Thank you. At this time, if you do wish to ask or state a comment, please press star 1 on your phone. That's star 1 on your phone.
Anyone there, operator?
At this time, I show no questions from the public.
How many folks did we have?
Great. Are there any other board matters for discussion?
This is Jonathan Hunter. I'd just like to make a brief comment.
Yes.
In the presentation, particularly on the business plan, when we saw the slides very quickly about the history of our ratings from S&P and Moody's, it just struck me that, I joined the board back when those boxes were all red. And this current crisis has brought a lot of anxiety. I've been feeling a lot of anxiety about what's going to happen to the hardworking families that we support, both in our multifamily but also single-family programs. I was pleased to hear the amount of detail and thoughtfulness that all of the staff are giving to the implications for the current situation. And the impact on the families that we try to serve. One of the things that was particularly striking, going clear back to something that Stephen commented on at the opening, an incredibly high percentage of people in affordable housing are still paying their rent in spite of all this stress. And I think that's testament to the fact that when people have an affordable home, it's the last thing they want to lose. And they will prioritize that over everything else. And I just think that's an important reminder to all of us about how critical the work of this agency is. So thanks.
Thank you, Board Member Hunter.
Here, here. Thank you, Jonathan. Well said. Well, I think on that final note, unless there's any other comments, let's stand adjourned. Go ahead.
I said it was great talking with everyone.
Thank you.
Everyone, thank you very much. And let's hear what the May revise has to say. Thanks all. Talk to you next time.
Thank you all.
Stay safe.